Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Will Ryan, CEO at Granite Shares. We're talking about single stock ETFs, particularly the 2X Nvidia ETF that has been wildly popular and very successful this year. Will, welcome back. Great to have you on the show.
Thank you so much, Nina. Nice to be back on the show.
So let's talk about Nvidia earnings. Nvidia, as usual, reported very strong results. Sales and earnings more than doubled, surpassing sky-high expectations. But the magnitude of those beats was slightly smaller compared to earlier quarters, and gross margins narrowed a bit. And that was partly due to production issues with their next generation Blackwell chips. But the company said that the production is going to ramp up and the demand remains very, very strong. I was surprised by the market reaction. The stock fell 6% yesterday. And for reference, we are talking on Friday, August 30th. So I wanted to start with your thoughts on Nvidia earnings and the market reaction.
Yeah, it was. I tend to agree with you that it was surprising, I think, in many ways, because it was another blowout quarter. I mean, clearly a company that's able to not just double revenues in a year, but exceed that with a margin of over 70%. Is an incredible achievement kind of in anybody's book. So the balance sheet's growing, and clearly they announced that they'd be doing a $50 billion stock buyback, which kind of goes to show the strength of the free cash flow that's accumulating in the company. So yes, I mean, I was surprised, on the back of such amazing results, that the stock was down. And the only real thing I can think about, other than some of the reports that you mentioned, that the whisper number in the market was slightly higher than they actually reported, I sort of think that I'm inclined to think that it was more about this particular climate over this earnings season, where we've seen this from some of the other mega tech companies, where they've kind of generalizing a little bit, but they've reported good results. But if one thing has been slightly off, the stock has been punished for that. So I do think that's just kind of a phenomenon that's hopefully unique to this earnings cycle. We've certainly seen still huge amount of an interest in Nvidia, and I think there's nobody in their right mind suggesting that Nvidia as a story is over. And clearly the company's growing at such a rapid rate that if you take a step back, Nvidia is going to be a much, much larger company in the next few years. So yeah, in a nutshell, I was surprised probably just as much as everybody else.
Now, let's talk about single stock ETFs and NVDL. So single stock ETFs made their debut in the US a little more than 2 years back, though they have been around in Europe since 2018. So initially, these single stock ETFs really struggled to gather assets. And when they launched, there were a lot of negative stories in the media. Who needs these products? And some regulators also raised concerns over risks associated with these products, but that was before the AI mania and before Nvidia became the most important company in the world. And here we are, NVDL has about $5 billion in assets now. It is up about 336% year to date, I checked, even though it has remained almost flat over the past quarter. So very exciting performance, very exciting asset gathering. But before we talk about NVDL a little bit more, could you explain to our listeners how these single stock ETFs work?
Yeah, so this is a new category of ETF, as you mentioned, that was pioneered by Granite shares, first of all in Europe. And then we brought this to the US now about 2 years ago. And, put simply, this is leverage that is packaged within an ETF, giving exposure to, in most cases, it's 2 times or 2x exposure to the daily movements of an underlying stock. So obviously, subject of this podcast is Nvidia. And, in the Granite Shares suite, you have both a 2x Nvidia long ETF, which is NVDL, and then a 2x Nvidia short ETF, which is NVD. So providing movements to 2x on the long side and then 2x on the short side as well. And so again, for simplicity's sake, if you're in NVDL, that's 2x on the long side. If Nvidia goes up by 5% in a day, NVDL will go up by 10% in a day. So just as a sort of simple example.
Great. And what do these products hold?
So they hold principally derivative contracts, and that's how they are able to obtain the exposure to the underlying stock. So these derivative contracts are known as swaps, which are effectively a type of derivative contract that the fund obtains from large investment banks or broker dealers that enables it to maintain a leveraged exposure, 2 times leverage, for example, to an underlying stock.
So why did single stock ETF succeed, whereas single stocks futures could not? Is it mainly because futures leverage was mostly inaccessible to retail traders, or it is because ETFs have already, set up capital market infrastructure with market makers and all that, and it is very easy for them to hedge with swaps and futures and other instruments?
That's actually a really good question. It's probably a subject of a podcast in of itself. I don't really have a great answer to this because I'm not 100%. I don't really have deep expertise in the single stock futures market and kind of why that didn't really take off. I do think that the ETF market is fundamentally a greater or larger ecosystem. And so for anything to survive and thrive, typically, a larger ecosystem, all things being equal, would provide a better opportunity for success. Maybe the players that were involved, weren't sort of committed to supporting it in the same way that, again, players in the ETF ecosystem are committed to supporting ETFs. But it's a good question. And I don't really have a great answer as to why single stock futures never really took off.
Yeah, ETFs have really democratized investing for investors. There's so many sophisticated investment strategies which were earlier available to institutional investors only. Now, individual investors can also get access to those strategies and almost at the same price, right?
Yeah, no, absolutely. And it really just is the new technology, if you want to look at it that way, for investing, replacing the mutual fund. And I think sometimes what confuses certain members of the media and others is that ETFs are just a wrapper. The ETFs don't stand for one particular type of investment strategy or one type of investing philosophy. It's just a wrapper. It's just a technology that contains whatever investment strategy people are able to put in it, and that can vary from long-term buy and hold strategies to short-term trading strategies.
So you started these single stock products, ETPs, in Europe in 2018, as I mentioned earlier. And here in the US, there were some regulatory hurdles. So that is why investors had to wait for a long time. So could you talk a little bit about the new ETF rule and what made these products accessible to investors in the US?
Yeah. So put simply, when we started Granite shares, so 7 years ago, when we started the company, there was a very strange regulatory quirk that existed whereby only two companies in the US were able to issue leveraged ETFs. And that was a quirk of the regulatory regime and regulatory environments of that time. And that was under a regime whereby companies, issuers like Granite shares, had to go to the regulator and ask for something called exemptive relief, which was really the way that you bought products to market was by asking for specific type of relief to bring a specific type of ETF to market. And that was a great example of how this process was extraordinarily inefficient and created all sorts of market anomalies that ultimately the regulator cleaned up a few years ago under a new rule, which was known shorthand in the industry as the ETF rule. And relevant to this conversation, what the ETF rule allowed is for anybody to launch a leveraged ETF. And really the only restriction was that the leverage factor or the amount of leverage couldn't be more than 2x or 2 times. But that was really the kind of the breakthrough that allowed firms like Granite shares to launch funds and compete, in a market which hadn't really had competition for the best part of 10 to 15 years. So it's really allowed, like, competition does, it's allowed for a lot more innovation in the market. And obviously customers in principle are the biggest beneficiaries of a market that's vibrant with new innovation and ideas.
Great. I agree with you. More trading tools, more investing tools, they're always good for investors, but investors should know how to use them. And we'll talk about the user in a bit. But you talked about the leverage factor being restricted to 2x in case of single stock ETFs in the US. In Europe, you have 3x Nvidia ETFs as well, and 3x ETFs on other single stocks too. In the US, we do have 3x ETFs on indexes. For example, TQQQ, that is the most popular ETF with about 23 billion in assets. And we have a 4x ETN on the S&P 500 index as well. When will US investors get single stock ETFs with higher leverage? Are you applying for 3x ETFs on Nvidia and other popular stocks?
We're not. I don't have any real reason to believe that the environment will change in the short term. And so again, with the 3x, that's still a quirk of this previous regulatory regime where, yes, now the playing field has been, I would say, leveled somewhat, but it hasn't been leveled flat with a roller. And so there are still some bumps on the playing field. And that is one of them where existing companies that had 3x products are still allowed to have those products, but they can't issue or nobody can issue new 3x products. ETNs are a different category because they're not ETFs. They're a different type of product. So they come under a different regulatory classification. So that's a different rule set kind of altogether. But I think there may be like all these things, it may be possible that the regulatory regime evolves and that we're able to get to a point where the regulator and the market is a bit more, comfortable with leverage factors that are higher for certain products. But I'm not sure we're there today.
So now let's talk about the use of these products. So these are like sophisticated tools which should be used by investors, only investors who understand them properly. So what do you recommend how these products should be used? Should these be used only as short-term trading tools, or regular investors can also maybe allocate a small part of the portfolio, maybe earmark that part as suitable for speculation or gambling or something like risk capital? What is your recommendation?
So I think it really depends on what you're trying to achieve. But the point you mentioned is the most important one, which is that people shouldn't be investing in anything unless they fully understand how it works. And I think what we are seeing, certainly in our experience in this, is that people use the product for all sorts of different things and all different ways. And I think that the one thing I would say is, regardless of the holding period, and we can talk about exactly how the returns are manufactured, that these are not products that people should just forget about, that people should be monitoring their portfolios on a daily basis. And the reason for doing that is because of the way that the portfolio rebalances, which is every day. So that is one thing for sure, is that people, whatever they're doing, however they use the product, they should be looking at this on a daily basis, because markets move on a daily basis, stocks move on a daily basis, and when you have leverage applied to that, there's going to be volatility in those returns. But we've seen a lot of different applications, from anything from purely directional plays, which are going to sound obvious, to hedging strategies, to now increasingly, I think people are starting to replace, options trading with these products. And that's why I think one of the reasons they're becoming more popular, because people can trade leveraged single stocks in the pre-market and in the post-market, which you can't do with options. And a lot of people are realizing that there's some of these names, the options market, if some of the stocks have really high implied volatility, the premiums that they're paying on these options are so high that even if they get their call directionally right, they're still in some cases losing money because of the amount of premium they're paying, which doesn't exist. That concept doesn't exist with levered single stock ETFs. So I think increasingly there's a sort of a pool of options users which are coming over to leverage single stocks because of the inherent advantages they pose over options.
Very interesting. And I see one use case before or after earnings as well, because Nvidia stocks like Nvidia or Tesla, these are high beta stocks, and they could be particularly volatile around earnings. And for high conviction traders or investors, those pullbacks could present short-term buying opportunities. So that is one use case which I usually recommend. But again, these are not buy and hold products and suitable only for investors who monitor their portfolios very, very closely. So who are the main users of these products currently, and what is the average hold time that you have seen?
It's difficult to really say who are the main users. Because I think by main users, the categorization would have to be in terms of either volume, trading volume, or of assets, and that would obviously skew towards large, trading firms, hedge funds, proprietary trading firms. But I think that I would sort of categorize it more as being that I think the users are self-directed investors. I think that's kind of the key thing. And self-directed can take the form of anybody from retail investors to, the most sophisticated investors in the world, and kind of everybody in between. So I think that from that perspective, there's, with a fund like NVDL, $5-6 billion in terms of assets. I mean, clearly you have just a massive plethora of people that are investing in that fund. And those are institutions, they're individuals, and like I said, there's a huge, huge range. In terms of holding periods, it's obviously something that no ETF issuer has that data, because only the brokers who actually look after the end customers have that data. But my guess is it's somewhere between a few days to a couple of weeks. I think the turnover typically we see is on assets of our overall book of $8 billion. We turn over somewhere in the region of $1 to $2.5 billion a day. So there's just a monumental amount of volume going through the platform. And I would think that with that sort of turnover ratio, it tells you that people are holding it for relatively short periods.
That's good to know, and very interesting trends. So there's so many single stock ETFs available to investors now. Almost every week we see a new single stock ETF launching, but a big portion of assets as well as trading volumes that is concentrated just in a handful of names, and mainly Nvidia and Tesla. So in fact, some of the single stock ETFs have already closed because of the lack of investor interest. And earlier, I used to think that investors mainly chase performance. So whatever is hot, whatever is doing very well, they'll put their money over there. But that's not always the case. For example, I saw that Defiance recently launched single stock ETFs on Eli Lilly and MicroStrategy. And these were the first ever single stock ETFs on those two stocks. And the one on Eli Lilly has gathered just $5 million, whereas the one on MicroStrategy, which was actually launched about a week later by Defiance, that has already gathered 170 million. So it seems that investors and traders, they have very little interest in the hottest healthcare stock, which has almost doubled over the past year. So why do you think that some of these products just take off and the others are largely ignored by investors?
Yeah, it's a great question. And again, there's not really a kind of a great answer to it other than, stocks themselves are, the product of hype cycles, of particular sort of peaks and troughs of interest. Maybe it can also be a fact that certain stocks kind of allow people to do things which ordinarily they're not allowed to do. So, for example, some markets, some places, cryptocurrency investing is still outlawed. And so by gaining exposure to a Coinbase or a MicroStrategy, you're able to kind of achieve that, albeit through a proxy. So it's difficult to say, why a particular stock is popular than another, but that's in a nutshell kind of what the market is. It's a marketplace for ideas, and some people like certain stocks way more than others, and leveraged single stocks are certainly something that not every stock is going to be popular in the same way that not every stock is popular in the market, but there will be some that just capture that interest, that enthusiasm from investors, and it's the job of companies like us to try and predict what those might be to the best of anybody's ability.
Right. So what's next for Granite shares? You started with commodity ETFs. Your gold ETF was very popular. It was one of the lowest cost gold ETFs earlier. We used to talk about your gold ETF, platinum ETF, and the broader commodity ETF comb. Now you have so many interesting single stock ETFs. And I saw that you recently filed for 25 yield boost ETFs. These ETFs are designed, they will kind of combine two of the hottest investing trends in the ETF market currently, leverage and options-based covered call ETFs. So tell us about what's next for Granite shares, and how do you decide the process of deciding what products to launch next?
So we've actually got some new products launching next week. So watch this space. So we have three new products launching next week. The yield boost offering is slightly different. So that we are going through the regulatory registration process to bring those to market. So I can't say too much about that other than we're very excited to bring again another completely new category to market, which doesn't exist today. So we've had a lot of interest in this, as you can probably understand, and certainly look forward to talking more about it, as we get to launch with those particular funds. But next week we're launching three more leveraged single stock funds. So excited for that.
Excellent. Good luck with these launches. And congratulations on NVDL success. We'll have to leave it there. Thank you so much for joining us today and for sharing your insights.
Thank you so much. Always great to be on the show.
That was Will Ryan of Granite Shares. The 2X Nvidia ETF again is NVDL. This has about 5 billion in assets, and T-Rex and Direction also offer 2X Nvidia ETFs. They are much smaller. The one by TX, the ticker symbol is NVDX. It has about 625 million in assets, and the one by Direction is NVDU that has about 500 million in assets. Now, if you want to short NVIDIA, the one by Granite Shares is NVD, Granite Shares 2X Short NVIDIA Daily ETF. And these ETFs are much smaller because there are not many NVIDIA bears out there. So this has about 70 million in assets. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.